So thank you everybody for attending this session today on ESG theory and empirics. I think we've got some pretty interesting papers. Obviously they're all on ESG related issues, but I think there are some interesting commonalities and differences across the different works. So I think we've got a very good session today. I'm going to hand it over to Anna for ESG confusion and stock returns. 15 minutes of presentation. We'll have about 5 minutes for Q&A. You can use the Q&A box, so I may end up selecting 1 or 2 questions. After the question period, we'll transition to the next presentation, and I would hope we'll have some residual time at the end of the session for additional Q&A. So I'll hand it over to Anna, and I'll give you a heads up with 5 minutes to go.
Thank you for including our paper in the program. This is joint work with Florian, Julian, and Roberto, who are all here. Practitioners often use the words tectonic shift when describing the impact of ESG investing on the asset management industry. We see an exponential rise in ESG-linked assets across all markets. How do portfolio managers construct ESG portfolios? Well, they commonly rely on ESG ratings provided by rating agencies. However, as my co-authors point out in their previous paper, it is very difficult to measure some ESG attributes, and hence we can see a lot of noise in the raters' estimates. You are a specialist audience, so let me give you straight away the correlation matrix of ESG ratings of different raters in our sample. We've got 8 raters, and TVL here stands for True Value Labs. The rest are self-explanatory. These correlations look nothing like those of credit ratings among different raters. For credit ratings, you'd see correlations of over 90%. The average correlation here is only 20%. This paper is about measuring the impact of ESG performance on stock returns. But our methodology here can be applied more broadly to other firm-level outcome variables. We develop a model which, among other predictions, has an implication that when ESG performance is measured with noise, the effect of ESG on stock returns is harder to detect. It falls straight out of the model that standard OLS estimates suffer from attenuation bias. To correct the bias, we propose to use an IV approach. We propose to instrument ESG ratings with other ESG rating agencies' ratings, borrowing the idea from the classical errors and variables problem. After all, ESG ratings of different agencies are noisy measures of exactly the same thing. We show in simulations that our procedure works much better in our application than other noise reduction techniques, namely averaging ESG scores or the principal component analysis. If you would like to hear why, please ask us in the Q&A. We find that on average, standard regression estimates are biased downward by about 60%. We estimate the noise to signal ratios for each ESG rating agency. For some agencies, these are large. I'll show you the numbers. And I will then show you firm rankings based on raw scores and then compare them to rankings coming out of our procedure. 3/4 of firms change their decile after we denoise the ESG data. 63% change quintiles. So if one does a standard portfolio sort based on deciles or quintiles, many firms may end up in wrong bins. And finally, we find that scores of some agencies are not valid instruments and hence should be excluded from the estimation. I unfortunately do not have time to talk about our theoretical part, so let me just give you the predictions of our model. First, green stocks trade at a premium or a green yield. Their prices are higher and hence the expected returns are lower. Second, the more ESG investors there are in the economy, the higher the value of green firms. An inflow of ESG investors, if unanticipated, creates price pressure that pushes prices of green stocks higher. Finally, and very importantly, the noisier the ESG signal, the harder it is to detect the impact of ESG performance on stock returns. The relevant regression coefficient is biased towards 0. Let me now move to econometrics. The first equation you see is the structural model we want to estimate, how expected stock returns depend on the unobserved true ESG performance Y. We observe a noisy measure of Y, an ESG rating, which we call SI, I indexes ESG raters. And so one can estimate this second regression on the slide. Consistent with our theory, in the presence of the errors and variables problem, the OLS estimate in this regression is going to be biased towards 0 in the presence of the noisy regressor measured with noise. This is the attenuation bias, and the noisier the rating, the bigger the variance of the noise, the bigger the bias. To tackle the bias, we use an IV approach. Specifically, we propose using other rating agencies' scores as instruments. These scores, we argue, are noisy measures of the same thing. Here are the key assumptions behind our IV estimation. First, we assume that all ratings contain information about the true ESG performance Y, as here are the ratings of different agencies. This is the relevance assumption. For this talk, we will model all the ratings as truth plus noise. And the measurement noise here, these epsilons, Y, are independent of the true ESG performance Y and independent across raters. Our second assumption is the exclusion restriction. It says basically that our instruments are exogenous. We admit that it is possible that some of the key assumptions on this slide could be violated. Given the institutional setup, we are worried that measurement errors could be correlated across agencies, violating this assumption 1. For example, some raters in our sample are more prominent ones, and other raters might be influenced by their ratings. Or, for example, 2 rating agencies might be using a similar procedure to arrive at the ratings. What helps us is that we have plenty of instruments, 7 of them. And hence, we can run the so-called over-identifying restrictions tests. And we show in simulations that these tests are a great tool to diagnose violations of the assumptions in our specific applications. We will use these tests to weed out instruments that are not valid. And now to our empirical analysis. We use 8 different ESG rating agencies listed here. We have firms from North America, Europe, and Japan, and our data are monthly from 2014 until 2020. ESG agencies use data from different sources, sometimes non-overlapping. You might be thinking that there are some discrepancies in how ESG ratings of different agencies are constructed. Our method still works, even if ratings cover a different set of attributes, as we show in simulations. If you would like to hear more on this, please ask us in the Q&A. These are the details of the regressions that we are running to estimate the effects of ESG performance on stock returns. I'll show you results for both OLS and 2SLS. We use individual stock returns, not portfolios. And we control for the standard asset pricing characteristics that also include industry, country, and time fixed effects. Let us now look at the results. We break them by geographical regions, North America, Europe, and Japan, and we run our regressions for each of 8 ESG raters in our sample. These raters are listed here on the left. So the first takeaway from this table is to compare the OLS estimates and the 2SLS estimates. And what you can see from this slide is that the majority of the estimates go up when we switch from OLS to 2SLS, exactly as our theory would predict. I mark the ones that go up in bold. So that is evidence of attenuation bias that we are correcting. Let me also draw your attention to the fact that the estimated coefficients are overwhelmingly positive. Theoretically, firms with high ESG scores should have lower expected returns. And in our sample, we see the opposite. Green stocks have higher returns. We know from our model that the coefficient on ESG captures 2 effects, one negative and one positive. The negative one is the greenium, that green stocks have higher prices and lower returns. And the positive is that higher ratings bring an inflow of new ESG investors. We find that the effect of fund inflows into ESG dominates in our sample. Realized returns on green stocks have indeed been higher. This, however, does not affect our noise correction procedure. Our procedure is about correcting the measurement error, and it corrects it regardless of the sign of the coefficient. It is probably better to visualize these results in a figure which plots the differences between 2SLS and OLS estimates. The blue bars are the positive differences that the model predicts, and the tan bars are negative. It is very unlikely that so many coefficients across different regions go up at the same time for completely random reason. We view this as evidence that the bias we are documenting is indeed the attenuation bias. On average, OLS estimates are biased downwards by 60%. So if you have a paper documenting that ESG ratings matter, the effect is probably much stronger than you thought. We can also extract the noise to signal ratios applied by our estimates. And here are the results. These are the least noisy. These are the noisiest raters. The scores of True Value Labs, abbreviated as TVL here, the social media and news-based ratings provider are naturally very noisy, and they occupy 3 out of 6 top spots. At the bottom, you see MSCI and Sustainalytics for North America, the 2 big ones in the US, and they contain the least amount of noise, about 10%. We can totally see how practitioners are going to draw a conclusion that we are endorsing MSCI and Sustainalytics. That is not our message. If you disregard scores of other raters, you throw away valuable information. Intuitively, by combining information from self-disclosure, questionnaires, expert assessment, etc., one could get the most precise signal about the unobserved ESG performance. For illustration, let me show you how many companies move up or down ranks after instrumentation. In standard portfolio sorts based on raw ESG ratings, one would rank firms by their ESG scores and allocate them into deciles or quintiles. In this slide, for each geographical region and each rater, we compare firm ranks based on raw scores from the rater and on denoise scores based on our procedure. On average, 3/4 of firms change their decile after we denoise the ESG data. 63% on average change quintiles. So in this application, it seems that noise has a significant impact on portfolio construction. We have many instruments. In such situation, one can run the so-called Hansen J test of over-identifying restrictions. What the test does is that it checks whether instruments are valid or not. You can run it only if you have 2 or more instruments. We've got 7. So here's our precise procedure for selecting the best set of instruments. For each rating, we use all other agencies' ratings as instruments and run the Hansen J test. If the model passes the test, all instruments are valid, full stop. If the model fails the test, exclude instruments one by one until it passes. The remaining set of instruments are our pruned IV. Let me now tell you which instruments make it to the pruned IV. First, we do not have a problem of weak instruments. You can see the first stage F stats in this rightmost column. They range from 95 to over 7,000. Second, we do get a number of rejections for our instruments from the Hansen J test. That's good, shows that our over-identifying restriction tests have enough power. A check mark means that an instrument passes the validity test, and the cross means that it fails. No rejections in Europe, interestingly, but they are rejections in North America, meaning that instruments with a cross are not valid and should be excluded from the estimation. Interestingly, the instrument that consistently passes the J test is True Value Lab, abbreviated as TVL here, a news-based AI ratings provider. It is super noisy, but it is a great instrument. Noise in this variable is truly orthogonal to noise in the other scores. Given the institutional setup, we think that our assumption that measurement errors are independent across raters may be violated for some raters. This might happen if raters take into account scores of other raters. For example, MSCI Sustainalytics, the big 2 in the US, when constructing their ratings. When such influencers are, such influencers are not going to be good instruments, and the over-identifying restriction test picks this up, and then we can exclude them. We talk about other possible reasons for getting rejections of some instruments in the paper. As we show in simulations, it is very important to drop such raters from the set of instruments. Or if you're using an average, very important, not included in your average rating. I did not have time to discuss an alternative instrument selection procedure that we use in the paper with instrument selection based on lasso. The good thing is that the results from that procedure are very similar. To conclude, in this paper, we show that standard estimates of the effects of ESG performance on stock returns suffer from attenuation bias. Our proposed solution is to use instrumental variables. Specifically, we use ratings of other agencies as instruments. We show that the noise to signal ratios are high for most raters. Noise in the ratings has a significant impact on portfolio construction. Firms' rankings based on raw ESG scores is quite different from the one after instrumentation. Finally, we find that all ESG ratings predict each other very well, very strong first stage, but not all are valid instruments. Our next step in this project is to construct an ESG index, an intelligent weighted average of ESG agencies' scores, with some agencies excluded from the index. And that's all I've got. Thank you for your attention, and I look forward to the Q&A.
Thanks, Anna. I think given we ran a little bit over, but we still got some time and flexibility, I'm not seeing a huge number of Q&A pop up in this session, so I think we will move on to the next paper. So the next paper is the cost of ESG investing. Christoph is going to present that. I do anticipate, so long as our presentations keep moving, we'll have some additional time for Q&A towards the end of today's session. Christoph.
All right, thank you very much. First of all, thank you very much for including this paper in this very, very great session. I'm excited to present. The title is The Cost of ESG Investing. This is a joint work with Lindsey and Seth Pruitt, who are both at ASU and both here as well to answer your questions. So as Anna already lined out earlier, over the last couple of years, we've seen a dramatic increase in the demand for ESG investing overall. And as a result of this dramatic increase, fund managers are just increasingly looking for ways in which they can integrate ESG goals and mandates in their investment portfolios. But the implications of doing that are quite unclear. Theory generally says that we should expect lower returns for stocks with high ESG characteristics because investors don't require as much compensation to hold these types of stocks. And generally, we have a lot of evidence for this in the literature, people documenting this type of greenium effect. On the other hand, we have several papers, including Hartzmark and Sussman, Peterson and Gorgon, who document no effect on the return predictability of ESG characteristics. At the same time, some related research suggests that ESG mandated managers don't actually implement some of these goals that they claim to be implementing to their investors. There's also research that suggests that implementing these types of mandates is costly in several ways. It can affect portfolio diversification benefits. It can affect management fees and other outcomes like that. And so based on these contradictions in the literature, we're asking a relatively simple question that addresses this need for ESG mandates. And that is it possible to construct ESG portfolios without these types of costs, essentially for free? And if we find that, what is the reason for that? Why is that possible? What we bring to this question is a new sort of methodology that helps us answer this question. And this methodology is the instrumented PCA methodology that has recently been very successfully implemented for equities and for bonds by Kelly and others in several papers. This methodology has at least four sort of major advantages that help us answer this question. First of all, by not just estimating alphas and betas, but also the factors at the same time, we're able to better capture the mean variance efficient frontier, which is really important when we're trying to attribute the effect of ESG on returns to either alpha or to beta, and to be sure that we're not sort of falsely attributing this because of a bad factor model. Second, this model allows us to have cross-sectional and time series variation in both alphas, betas, or both, which can help us distinguish if there is return predictability due to either mispricing or systematic conditional risk exposures. At the same time, the model allows us to incorporate a large amount of different conditioning information that investors might already have or already do have at their disposal when forming portfolios. Then that might be overlapping with ESG characteristics. And in our paper, we're using data from a number of different ESG providers to make sure that our results and our conclusions are broad. All right, so what do we find? Well, first of all, we find that it is indeed possible to construct systematic portfolios that implement a broad range of different ESG mandates without giving up a lot of performance and a lot of profits. We can implement this both for relatively straightforward, simple ESG screens that are very typical in the ESG industry and in practice, as well as several models implied optimal portfolios from prominent papers in this literature. How is this possible? How can we find this? Well, we find that in our model, ESG measures do not predict returns, both with respect to mispricing alpha as well as conditional beta, the exposure to systematic risk factors. And this is true in the context of our conditional asset pricing model that includes a lot of information that investors have access to about these firms. We also show in the model in a theoretical extension that this is perfectly consistent with equilibrium theory, so long as there is disagreement across different ESG implementations and different ESG measures. As long as that is the case, we can document it, we can show that investors may take ESG characteristics into consideration, and yet those ESG considerations may not affect expected returns. All right, before I get to the data and the return, let me give you a brief sort of idea of what this IPCA methodology does and how we arrive at our conclusions. Broadly speaking, the IPCA, in the IPCA methodology, expected returns are a function of alphas and of exposure to systematic risk factors. The key sort of features of this methodology that make it different from existing models is that, first of all, both the alphas and the betas are instrumented with observable firm characteristics, which gives us conditional exposures to systematic risk as well as conditional alphas. The second thing is that the factors may come from existing factor models that we're all familiar with, but they may also be estimated. And by estimating these factors, as Kelly and others have shown in several papers, we're much better able to characterize the mean variance efficient frontier. And so armed with those estimates or those constructed conditional exposures, those betas, as well as the moments of the factors and the error terms, we can construct tangency portfolios and model implied moments for these expected returns. So what do we do with that? We do two things. First of all, we construct what we call systematic portfolios with a tilt. So we do this in two ways. The first way that we do this is to just construct the tangency portfolio as implied by this IPCA methodology without taking ESG characteristics into account at all. And then when we have that tangency portfolio, we screen out certain firms based on their ESG characteristics, which gives us ESG tilted tangency portfolios. The second way we do this is by taking the model implied moments of expected returns and implementing two widely cited prominent papers in this literature. First of all, Pedersen et al. 2020 and Pastor et al. 2021, which gives us ESG tilted Markowitz portfolios consistent with the ESG investors in the models in those two papers. Broadly speaking, those two approaches help us understand if it is possible to construct portfolios that implement a broad range of ESG mandates and what the impact of doing that is on performance and profit. The second thing we do with it is to directly include the ESG characteristics in the estimation of the IPCA methodology. We can do this either by including the ESG characteristics in the firm characteristics in the beta. We can include this only in the alpha, or we can include it in both. By doing that, we're able to see if we're A, able to predict returns, and B, if we're able to attribute this to exposure to systematic risk, to factors, or to mispricing, to conditional alpha. All right, so let me just say two more words about the data before I get to our results. The data is fairly straightforward. Our non-ESG data comes from CRISP and CompuStat for returns and firm characteristics. We rely on existing literature to get those observations. In general, we include 50 different firm characteristics to really have a rich conditioning information set for our tests. Our ESG data comes from 4 of the main data providers. That includes KLD, Refinitiv, which was previously known as Asset4, Sustainalytics, and RepRisk. And the data, as you know, varies pretty widely in terms of its coverage over time as well as across firms. One thing we do to both the ESG measures as well as the other non-ESG measures is to demean them to make sure they're in an interval between -0.5 and +0.5 so that we have comparability there. All right. So let me begin with our results with respect to implementing ESG mandates in the form of a tilt. As you all know, mostly ESG measures are available for relatively large firms. And so to make our results comparable in our baseline estimations, we focus on a sample of only large firms. We know that this is, from the previous literature, a tougher test. It's typically, we find it's documented there are lower systematic investment profits in these larger firms. And so this is quite a stringent test for trading profits. And so what you see here in this first panel is the Sharpe ratio and the annualized mean return for this tangency portfolio when we completely disregard ESG information and impose that there are no alphas. We see that this portfolio is really profitable with a high Sharpe ratio, which is highly statistically significant, and a large annualized mean return. What if we now include ESG in the form of a screen? Right. So what we do here is to essentially screen out firms from this tangency portfolio that are below a certain threshold of ESG scores. We drop firms below the 25, below the 50, below the 75 percentile ESG score. And what we see is that essentially this does not seem to have much of an effect. Sharpe ratios as well as annualized mean returns remain at almost exactly the same level as the tangency portfolios before we implement those screens. We go one step further and only drop out firms in the long leg to implement sort of an ESG mandate that suggests you cannot hold firms, you cannot go long firms that are bad ESG firms. In this case, we see that if we increase this threshold very, very far and implement a 75 percentile threshold, we do see a little bit of a drop-off in the performance of these portfolios, as you would expect. And so the broad takeaway is that a broad range of ESG mandates can be implemented in these systematic portfolios without giving up much in terms of performance and profits. However, of course, this is not without any limitations. If you drop out most of the firms, this will impact the performance. We do similar things by implementing the model of Peterson and others, which has an investor who optimizes returns conditional on a certain average ESG performance in their model. We go through a number of different target average ESG scores in the portfolio of this investor. We go through a number of different ways of dealing with missing observations, either setting them to 0 or to -5. The broad message is across all of these different approaches, the Sharpe ratio and the annualized mean return of these ESG mandate compatible portfolios remains very, very, very similar to the performance of the tangency portfolio. We find the same result if we implement the model of Pastor and others. In this model, there is a taste parameter for an investor's preference for ESG investing. When we set this preference to a very strong value, in this case, D equals to 0.01, we do find that the performance of this portfolio drops off compared to the tangency portfolio, but that is a very, very strong taste parameter. When we assume more mild and probably more reasonable parameters, we see that again, the performance in terms of Sharpe ratio and mean of these portfolios, which are consistent with the Pastor and others paper, is very much in line with the tangency portfolio. We go through a number of robustness tests with alternative ESG providers, alternative sample periods, alternative measures, alternative ways of capturing the ESG, alternative factor specifications, and we always find similar results across all of these measures. And so the takeaway here from this first result is really that it is possible to implement a broad range of ESG mandates in these systematic portfolios without changing much about Sharpe ratios and without changing much about average returns, which remain high and statistically significant. So how is this possible? How can we possibly achieve that? Well, to answer that, we next ask the question, do these ESG characteristics help us predict future returns, either in the form of risk exposure or in the form of mispricing? And so we include ESG characteristics in the model itself, in the IPCA, to either construct portfolios that have ESG characteristics in there to measure exposure to systematic risk, or to construct portfolios that are orthogonal to those systematic risks, but include ESG to construct sort of pure alpha strategies. In the middle, in the middle two columns, you see the results for the effect of ESG characteristics as risk exposure. On the columns on the right, you see the results with respect to forming pure alpha portfolios. And what you see is that relative to not including ESG characteristics, either in the form of risk exposure or in the form of pure alpha, we see very little change, right? So the Sharpe ratio and mean of the portfolio constructed without ESG characteristics is very, very similar to the ones that we achieve when we do include ESG characteristics in the set of firm characteristics. This is virtually the same across different ways of including it, setting missing observations to either 0 or -5 or minus 0.5, or focusing only on those firms where no ESG characteristics are missing. Similarly, we find similar things as what the literature has found as well. Firm characteristics that are observable do not help us construct conditional alphas that have sort of a significance and are positive. Including ESG characteristics does not change that, does not increase that ability. So we continue to not be able to find, to be able to construct pure alpha strategies even after including these ESG characteristics in that set as well. Right. So what if we include ESG characteristics only in the estimation of alphas and use all other firm characteristics to construct the betas to measure risk exposure? The message is exactly the same. Across KLD, SF4, Sustainalytics, and RepRisk, we do not find that including ESG characteristics helps us construct portfolios that are orthogonal to the systematic risk, but provide any kind of measurable performance. We see that the Sharpe ratio as well as the annualized mean return is indistinguishable from 0 across all different specifications as well as different data providers. All right, we run through the same types of robustness tests that we did for the other test and find very, very similar results there. And so taken together, what our results indicate for this test is that ESG scores do not seem to be giving us any type of useful information for constructing profitable trading strategies or profitable portfolio strategies, neither with respect to exposure to systematic risk, nor with respect to mispricing in this conditional framework, right? And so what we then do next in this paper is to relate our research to other papers that have focused on similar questions, and translate the unconditional framework that these other papers have used to our conditional asset pricing framework. Specifically, we're looking at two papers, Passer and others' paper on the environmental dimension of ESG. They construct the green factor. We're going to hear much about it later in the session, and find a French alpha over the recent decades. We also look at a second paper that focuses more on the social dimension, and look at Edmonds's employment satisfaction factor. We are able in our paper to replicate both of these papers and find the same results in terms of unconditional alpha. However, when we include the characteristics of those two papers in the conditional asset pricing model to construct the beta neutral portfolios, we do not find any more evidence for conditional alpha in this IPCA model. And in a way, this finding really strengthens the conclusions and the proposed idea of the Passer and others paper, saying that unexpected shocks that occur over time can produce outperformance or can produce alpha of these green factors, but there's no reason to believe that this is reliable alpha going forward once we condition on all available information. All right, in the very last part of the paper, I think I'm zeroing in on that time. We're sort of trying to put this finding in an equilibrium framework to understand better how this is possible. Shouldn't we expect that as ESG mandated investors include these characteristics, the stock prices of firms with bad characteristics should be falling, their expected returns should be rising, and ESG characteristics should start to predict returns? Well, the answer actually is not necessarily. As we've seen from what I've shown you so far, there are a number of different ways of implementing ESG. There are a number of different methods and a lot of different measures. And in an extension of Passer's paper, what we see is that As long as these different measures of ESG performance don't perfectly agree with each other, or as long as they're uncorrelated with each other, it is absolutely possible in the model for investors to take ESG considerations into account in their portfolios, and yet for those not to affect expected returns. And so this is exactly what we test in our data. Essentially, we're just constructing cross-sectional correlations, rank correlations across our ESG measures across the different ratings providers, and plot the densities here in this chart. And the main thing to take away is that the majority of the mass of this density plot is concentrated in the middle at 0, indicating that essentially these ESG measures are related in a random way and don't agree very much. And in this reality, it is very much plausible for investors to take ESG concerns into account when forming their portfolios, and yet there to be no equilibrium effect on expected returns. And if we take this sort of to its logical conclusion, we would expect there to be a world essentially in which ESG mandated investors actually appreciate the fact that there are many different measures, because it allows them to implement ESG mandates without sort of sacrificing returns, as we've documented in this paper. All right, so I think I'm coming up on the end of my time. So let me summarize what we do here in this paper. First, we document that it is indeed possible to construct systematic portfolios that implement a pretty wide range of ESG mandates without sacrificing much in terms of profits or return, a risk-return trade-off. We're doing this both for simple ESG screens, as well as 2 of the most prominent papers in the literature on model implied optimal portfolios. Why is this? Well, we find that ESG characteristics do not help us predict returns, neither with respect to mispricing nor to risk exposure. However, this is in a conditional asset pricing framework, right? Where we always take into consideration all this other rich conditioning information which investors have access to. And then last, we show that this is perfectly consistent with equilibrium theory, so long as the measures of ESG that we're typically using don't agree with each other, and this is exactly what we see in the data as well, and what we've seen in the previous paper. Thank you very much. I am very much looking forward to any and all questions in the Q&A.
Terrific, thank you, Christoph. So again, we'll move on to the next paper, and as we ran a little bit into the Q&A time. So as with the prior 2 papers, I'll allow the full sort of 15 plus 5 for the presenter, and we'll defer Q&A. So the next paper, again related, but taking a little bit of a different tack, quantifying the impact of impact investing, and focusing on both the costs and the benefits. So there are a cost component in this paper. So I will hand over to Ruixun.
All right, thank you very much. First of all, I'd like to thank the organizers for including our paper in this great session. So it's really a great pleasure to be able to present today. My name is Ruixun, and this is joint work with Andrew Lowe, who is also here. So today I'm going to talk about a new framework that we propose to analyze impact investing. So first of all, what is impact investing? I think most of us already know this, but for the sake of argument, let's define it as the form of investing whose purpose is not just maximizing risk-adjusted returns, but also includes other non-financial considerations. Or a different way to put it is that one still maximizes the usual risk-adjusted returns, but subject to certain constraints about social priorities in one form or another. So this, of course, includes SRI and ESG as the most prominent and important examples. So one question I always had regarding impact investing is whether the fiduciary duty has been met as investors on behalf of our clients. So we know that a fiduciary has to act solely in the interest of investors. So when asset managers adopt non-financial objectives, does that necessarily mean sacrificing some returns? So therefore, my goal today is to provide a framework that can help us answer questions like this in a quantifiable way. So how do we evaluate impact investing? Okay, so instead of investing among the entire universe of assets, impact investing adds an additional constraint that restricts ourselves to a subset of assets. Then it seems natural that when we do the optimization over that constrained subset, we're not going to do as well financially. Now, to get some intuition for this question, let's take a look at two examples. So let's say I just don't like companies that start with the letter F and exclude them from my portfolio. If I do something as silly as that, surely I'm going to reduce the risk-adjusted returns for my investors. However, now suppose instead that the subset that I'm going to restrict myself to is the stocks that Jim Simons will buy next month. Then I think you would agree with me that this constraint will actually improve my risk-adjusted returns, right? So these two simple examples suggest that whether we are hurting or improving investment performance by investing in such a subset depends critically on whether that subset contains information. So in other words, does the criteria that we use to form the subset has correlation with returns? So what we do in this paper is to provide a framework for formalizing these ideas and also for quantifying the degree to which you are going to help or hurt investors by engaging in impact investments, and finally, how to do it in an optimal fashion. So the paper contains 4 examples that shows how to apply the framework, but I'll probably only be able to talk about 2 given the limited amount of time. And in the paper, we also provide a literature review to relate our work to the rapidly growing literature on ESG and SRI, including, of course, the work from many of the authors here today. Okay, so how do we begin? So we start with the standard multi-factor linear model that we are all used to. So the return R beyond the risk-free rate of the ith stock is given by a constant alpha plus a series of betas times factor returns from 1 through k. So the key here is that we are not going to assume that the alphas are necessarily equal to 0. So in fact, let's suppose they're random, not constants. And let's suppose they are normal with mean 0 and some variance. So what we're saying here is that there may be excess performance, but on average, it's 0. So some people are good at it, others are not so good at it. It averages out to 0. But there are deviations from the standard asset pricing equilibrium with no alpha. Now, let's introduce an impact factor, X. So this could be a company's ESG score or the amount of carbon emission or any other metric that is associated with a security. So each security I has an impact factor Xi. So we're going to use this impact factor to construct impact portfolios. For example, we can rank stocks by their X values and pick the highest, or we can impose some kind of tilt or any other combination that we like. So if we put X together with each stock's alpha, then each stock is represented by a bivariate vector of X and alpha. So then if we reorder these bivariate vectors according to X, we end up with the usual order statistics of X. So this is represented by X sub 1 colon N, X sub 2 colon N, etc. So however, that is not what we care about. So what we care about is the investment performance of the highest ESG company, for example. So what we really want is to sort based on the X and ask the question, what is the property of the alphas associated with those X? So this is known as the induced order statistics. And we use the notation alpha sub bracket 1 colon N, alpha sub bracket 2 colon N, etc. to represent the alphas that are induced by sorting on another variable, which is X in this case. So we know that X's are in order because we sort based on them, but we don't know what the alphas look like. And that's what we need to quantify. Okay, so it turns out that this can be done, and we provide this result in proposition 2 of our paper. So we first start by assuming that X and alphas are jointly normally distributed with some correlation rho. So we don't know what rho is. It's some number between -1 and 1. But when we look at the alpha of the sorted X, and the expected value of that alpha is given by this equation over here with just 3 terms. So the first term is rho, the correlation between X and alpha. And the second term is sigma alpha, which is the standard deviation of alphas in the universe of the investment. And the third term is just a standardized impact variable that really captures whether you're above or below the mean impact value in the universe. So let's take a look at a simple example to understand what this really means. So suppose we have 50 stocks in the universe and we rank them based on some impact variable X. So the X-axis here represents the rank from the smallest one to largest 50. Now, the Y-axis represents the expected value of those alphas ranked based on the X, which is just the mu I here. So when X and alpha are positively correlated, so this shows that the expected alpha is positive for the top ranking stocks and negative for the bottom ranking stocks. And on the other hand, when the correlation is negative, we got the opposite result, which is that the expected alpha is negative for stocks with higher impact and positive for stocks with lower impact. So, okay, this is very intuitive. And in addition, there's actually a different way to look at this result. So remember that alphas are always unobservable. But what if we have an oracle that knows all the alphas and we can just rank securities by their alphas? So it turns out that we can write the expected value of these induced alphas in terms of the traditional order statistics of the alphas times the correlation rho. So this additional results basically says that the induced ordering is really just ordering securities by their unobserved alphas, but with a discount. And that discount is precisely rho, which is the correlation between the impact factor X and alpha. So this is the main result of the paper. And given that result, we can quantify impact investments in a lot of different ways. So in the paper, we've also provided the variances and covariances of the induced alpha, as well as the asymptotic results when the number of securities is very large. So in the interest of time, I will skip this part. And here I do want to point out that we can change the interpretation of alpha from excess returns to omitted factors. So imagine that you're a portfolio manager and your investor is only aware of one factor, let's say the aggregate stock market. But you know that there are other factors that have been priced, meaning there are other sources of a risk premium. In that case, you decide to invest in those other factors. So what you're providing to your clients are unique alpha in the form of factors that they otherwise couldn't access. So in this interpretation, there's no arbitrage, no inefficiencies, everything is perfectly priced. However, in this case, we do need to generalize our results by introducing dependencies across stocks. And the previous result that we have just discussed still holds with just a more complicated notion of adjusted correlation. So I'll skip the details of this generalization. Please feel free to take a look at our paper if you're interested in this part. Okay, so with the results that I've just showed, it turns out that we can calculate the expected alpha as well as the variance of that alpha for any arbitrary impact portfolio. So as a result, all of the standard tools that we know and love in terms of Sharpe ratio, Sortino ratio, information ratios, or performance attribution, risk management, everything we apply in modern portfolio theory is available now given these results. And not only are we able to apply them to calculate the impact of impact investments, we can actually optimize that impact. So this means to use the Trainer-Black approach, where once we quantify the alpha based on these sorted characteristics, the proposition 9 in our paper tells us how to construct portfolio weights that will maximize the investment performance of a given impact portfolio. And in addition, proposition 10 shows that how to combine that with a passive index portfolio. And finally, if we vary the level of desired impact by adjusting the universe of the impact ranked stocks that we are willing to include, this will correspond to the ESG efficient frontier of Patterson et al.'s recent paper. Okay, so in the last few minutes, I want to summarize by giving you just 2 examples of how this framework operates and why you need a framework like this. So the first involves venture philanthropy. So the idea of using venture to achieve certain philanthropic goals. And the second is ESG. And in the paper, we also considered SING stocks as well as meme stocks like GameStop, believe it or not. So the GameStop phenomena can also be studied as one form of impact investing. Okay, so let me start with venture philanthropy, the case of Seistic Fibers Foundation. So this is actually a nonprofit organization that focuses on dealing with patients with the disease called cystic fibrosis. And this is a rare genetic disorder that causes dysfunction in your lungs. And back in the 1980s, if you got it, the life expectancy of a patient is only 28 years. So since the 1990s, however, the CF Foundation has put about 150 million to the industry collectively to try to get a drug developed for this disease. So in exchange, they got royalty interests in a drug if it ever got approved. And long story short, that investment actually pays off with the first ever disease-modifying drug for cystic fibrosis approved in 2012. And this has generated about $4 billion of profit in total for the foundation. Now, if we try to impute what the implied correlation is between impact and financial return in this particular case, we got a very positive number. Now, our very stylized calculations here are not meant to yield a rigorous estimate of the true alpha associated with drug development. But what this shows is the potential of tremendously attractive financial return in this space. In fact, it turns out that probably the only way to get this return is by focusing on the societal impact and forget about the short-term returns. So the CF Foundation had no interest in profits, and the only thing they care about is helping their patients, as demonstrated by their mission statement here. So that's why they persisted when most venture capitalists shy away from this. So in this sense, the social impact and financial impact are not an either or, it goes hand in hand in this particular case. So, okay, now the last example goes back to ESG. We take a few representative empirical estimates of excess returns from ESG and plug them into our framework to calculate the implied correlation between each one of these ESG definitions. Well, not surprisingly, the correlations vary wildly depending on the specific metric, as Anna just highlighted in their paper, as well as asset class, region and time of the data set, and the specific form of asset pricing model used to estimate these returns in those papers. But nonetheless, if you're an impact portfolio manager who has found a positive correlation between returns and impact, well, that's great. But if you happen to use an implicit, if you happen to use an impact criteria that is negatively correlated with returns, despite the fact that you are advancing great social impact, from the fiduciary point of view, you will be hurting your investors, and you'd better disclose those correlations. So in conclusion, not all impact investments are created equal. What we are trying to do is to provide a framework for measuring and managing the financial impact of impact investing. And as investment managers, they should know the correlations with whatever it is that they are trying to achieve on the impact side, and just disclose to the investors. And more broadly, the statistics here applies actually to any characteristics correlated with returns, not just impact factors. But when applied to impact investing, it helps us to make sure that both financial and social impact are achieved, and finance doesn't become a zero-sum game in that sense. Okay, thank you.
Ruixun, thank you. Awesome timing. We'll keep moving along to the next paper. So the next paper, very much in the theme, consistent with the earlier work that we've been looking at today, but focusing on the environmental aspects. So dissecting green returns. And Luke is going to present this one. Thanks, Luke.
Great, thanks. You should be able to see my slides. We're very thankful to be included in this session. My co-authors here are Lukasz Pastor and Rob Stamball, who are both here today. In this paper, we ask, should we expect high returns from sustainable investments? Well, if you ask investors, they often say yes. Here we have 3 surveys in which they asked investors, why do you do ESG investing? Consistently, a top answer is they do it to get high returns. The second survey asks, do you expect your ESG portfolio to outperform? 60% respond yes. Asset managers, they also answer yes often. For example, Larry Fink of BlackRock writes, integrating sustainability can help investors build more resilient portfolios and achieve better long-term risk-adjusted returns. If you look at the kind of the historical performance of certain ESG investing strategies, well, it also suggests the answer here is yes. In our paper, though, we say no. We say you should not expect high returns from sustainable investments. There's a theory part of our answer, which comes from a previous paper of ours, a theory paper. Our theory predicts that sustainable investments have lower expected returns for two reasons. First, investors like holding sustainable investments. They dislike holding unsustainable investments. So these green assets, they have high prices today and hence low expected future returns. The second reason is that sustainable investments help to hedge climate risks. That makes these investments safer, so investors are willing to accept lower average returns to hold them. Now, you might say that you expect green companies to have high profits in the future. Well, if markets are efficient, those expectations should already be in prices today. So those expectations have no influence on returns. In this paper, we provide supporting empirical evidence. We showed that the past superior performance of a certain ESG strategy was unexpected. So our story is that concerns about climate change increased more than anticipated over the last decade, and that improved the returns, the realized returns of green assets over brown through potentially two channels. First of all, those climate concerns led investor demand for sustainable financial assets to go up, directly improving green returns. And second, those climate concerns arguably led customer demand for sustainable goods and services to increase, which again would improve realized green returns. So overall, the message from this paper is that the past performance of ESG strategies is not necessarily a good indicator of their future performance. So what sets our paper apart from the literature is that we're really focusing in on this wedge between the returns realized ex post and the returns that are expected ex ante. So most of our paper is about stocks, but we start with a simple case study about German green bonds. The German government has been issuing green bonds, and what's useful is that each green bond has a non-green twin bond. So you have two bonds with identical cash flows. One is labeled green, the other is not. And what we show is that the green bond outperformed its non-green twin. However, that performance was unexpected in the sense that the green bonds always had lower expected returns as measured by their yields to maturity. So we think it's a fairly clean example of how green assets have lower expected returns, but they can get lucky and have high realized returns. So then we turn to stocks. We show that green stocks outperformed brown stocks in the 2010s. By green stock, I mean in environmentally friendly stocks. So we're focusing on the E part of ESG in this paper. So we show this by constructing a theoretically motivated green factor. It's basically a portfolio that goes long green stocks, short brown stocks, and it weights them by their greenness. And this green factor's average return was very high, more than 0.5% per month during this period, highly statistically significant. But we showed that green factor's outperformance was unexpected. And it was due to unanticipated concerns, increases in concern about climate change. So specifically, we show that the outperformance of this green factor vanishes if we counterfactually set these climate shocks to zero. Or more simply, we're finding that the green factor's realized return was higher than its expected return in this period. That's our paper's main result. But we also show that the green factor's outperformance, it helps explain the historic underperformance of value stocks in the 2010s. This was the worst decade on record for value investing strategies. And green outperformance helps explain that because value stocks tend to be brown, while growth stocks tend to be green. Finally, we show that the green factor responds to climate concern shocks with a delay of about 1 month. So that's the summary. Let me jump into measurement here. We're going to measure stocks' greenness using MSCI's ESG ratings. I think that's the closest we have to an industry standard. In the first paper, so Anna's paper in the session, MSCI was the provider that showed up with the lowest implied noise. For the sake of time, I'll just mention that we're going to use MSCI's variables called the environmental pillar score and the environmental pillar weight, and we are not adjusting these scores for industry level greenness. So what we do first is we look at the returns on value-weighted green and brown portfolios. So the green stocks are those in the top tercile of greenness. Brown are in the bottom tercile of greenness. And here are the returns on these value-weighted portfolios. And what you see is that during this roughly 8-year period, the green stocks massively outperformed brown stocks. They outperformed by, I think it's 174 percentage points in this period. You can also see that outperformance if you look at the green factor that's suggested by our previous theory paper. So our theory tells us to construct this pricing factor, the green factor, by going long green stocks, short brown stocks, but we should weight stocks by their greenness. So in this chart, I'm comparing the performance of this green factor, shown with a solid line, to the value-weighted returns, green minus brown value-weighted returns, which I'm showing with the dashed line. The two series are pretty similar. So going forward, we're going to focus on the green factor. The green factor is basically playing two roles in our project. It's a theoretically motivated asset pricing factor, but it's also a convenient way to summarize green versus brown performance. So what we've seen so far is that the green factor's realized return is positive, very positive over this period. But remember, its expected return is negative, according to our theory paper. So how can we reconcile these? Well, our theory paper provides an idea, which is that our theory paper predicts that this green factor's realized return can be positive over periods of time when tastes are shifting in a green direction. For example, you can think of customers' tastes unexpectedly shifting toward green products. You can think of investors' tastes unexpectedly shifting toward green assets. So these tastes, they could have shifted for a variety of reasons, but we think a prime reason these tastes have shifted is because of people's increasing concerns about climate change. As we become more concerned about the climate, customers start demanding greener products, investors start demanding to hold greener assets. So next, we ask, can this green factor's past positive performance be explained by increases in concern about climate change? So to do that, to look into that, we need to measure concerns about climate change. We do that using this Media Climate Change Concerns Index that was created by these authors, Ardia et al. They aggregate data from 8 major US newspapers. In their index, it captures the number of climate change stories every day, as well as their negativity and focus on risk. We're going to measure the level of concern about climate change at the end of every month T. We're going to say how concerned we are at the end of this month T depends on how much scary climate change news came out in this month T. But we're also going to allow people to remember news from the previous months. This parameter rho is capturing the degree which people remember the news from previous months. So here in red, I'm plotting the level of concern about climate change starting in 2013. And hopefully to no one's surprise, one thing that's very special about this period in time is that there was this huge awakening, an increase in concern about climate change, even though it's not monotonic. I'm overlaying here the cumulative return on the green factor, and just eyeballing it, it looks like the series line up pretty well with each other. In other words, it looks like as we become more concerned about climate, that tends to be good news for green stock returns, bad news for brown stock returns. So to study that more carefully, we're going to run a regression. We're going to run a regression of monthly green factor returns on those month-over-month changes in climate concerns. And we're going to include the same month's change in concerns as well as the previous months. The same month change in climate concerns, it enters positively but not significantly. It's that previous month's change in climate concerns that load really positively. So what it's looking like, bad news about climate change is good news for green stock returns. We think that's intuitive, right? Because if we all wake up and we're suddenly more concerned about climate change, one thing that might happen is governments react. Governments act in a way that penalizes brown firms and possibly benefits green firms. Of course, the other thing that's curious here is that it looks like news is affecting prices with a delay of about 1 month. In the paper, we really dig into that, and we show that delayed reaction is mostly concentrated in small cap stocks. So next, we try to figure out, is this operating through a customer channel or an investor channel? If it's operating through a customer channel, then we should see returns loading on measures of cash flow news. We look at 2 measures of cash flow news. We look at earnings announcement returns, and we look at changes in forecasted long-run earnings growth. And we measure those for green versus brown firms every month. We're including those here in column 2. They enter with the kind of the expected positive sign, but it's not significant. In the last column, we're trying to look into the investor channel. We're asking, was it the growth of ESG investing or investors' tastes that drove up green asset prices? Our proxy for changes in investor tastes is ESG flows. This is a measure of money flowing in to sustainable funds. It also enters with the expected positive sign, but it's not significant. So next, we want to ask a what if question. What if the world had been different over the last several years? What if there had been no changes in concern about climate change? So to do that, we look at this model in column 2, and we compute monthly counterfactual returns after setting these shock variables to 0. Those counterfactual returns are plotted here in red. The actual returns are in blue. So what we're finding is that this huge run-up in green returns vanishes if we turn off those climate concern shocks. So this is the basis of our paper's main message, which is that green factor returns were largely unexpected and resulting from climate concern shocks. Next, we can kind of turn off some of those shock variables one by one. We do that in this chart. Again, the top line is what actually happened. When we turn off those climate news shocks, we get the green line. That's doing a lot of the work in pushing down the returns. If we additionally turn off cash flow news shocks, well, that doesn't change much. But when we additionally set those ESG flows counterfactually to 0, now the line slopes down. What we're finding is that absent those shocks, green assets actually would have underperformed in this period. That's consistent with our theory's prediction that these green assets have lower expected returns, but also consistent with our theory, look, if there are enough of these shocks, green assets can outperform like we saw them do in this period. So to conclude, our main finding is that realized returns exceeded expected returns for green assets in the 2010s, and it was largely due to unanticipated increases in concerns about climate. 3 important implications. First, for ESG investors, you should not expect green outperformance to continue. There's an important corporate finance implication because expected return is the same as cost of capital. Our findings suggest that green firms' cost of capital is lower than their recent realized returns would suggest. And finally, our results highlight that it can be very dangerous to measure expected returns using recent average realized returns, especially if you're looking at a special period like the one we've seen in the last 10 years, a period where there were these huge increases in concern about climate. And I'll stop there. Thank you so much for coming.
Terrific, thank you, Luke. Let's move on to our last paper for today. So we're going to be looking at sustainable credit risk. So a little bit of a switch where we had some bond examples in the paper we just saw. This one's focusing much more in depth on credit risk issues. So Lukasz, if you could take it away.
Perfect. Thank you, Stuart, and thank you very much for including this paper in this session. It's a pleasure and a privilege to be here in such good company. So this is joint work with Peter Deep and Scott Richardson, and as Stuart just said, we'll be looking in depth in credit markets, trying to see if ESG can be helpful in explaining patterns or maybe even building portfolios in that context. So what we do in that paper is really address two very broad and I think important research questions. Number one, does ESG information help us incrementally explain what is actually happening with prices? And you'll see we look at a variety of ex-ante and ex-post outcomes in prices. We look at a couple, well, the first two moments in prices, you look at returns and volatility of returns with, mixed messages, but we'll get there over the next couple of minutes. I will spend most of my time on the first part of the paper, but for completeness, in the second part of the paper, we ask the question, well, given the findings, how does this affect what investors would actually do with this information? We know that there is a lot of interest in building portfolios, including in credit, with ESG deliverables, ESG objectives. So what we are interested in is trying to understand how would this affect the composition of these portfolios and potentially outcomes as well. Okay. The data that we use is pretty standard in this space. We look at public markets, so publicly listed corporate bonds. You can see at the bottom left corner that our data as of the end of our sample includes roughly $10 trillion of bonds in North America, call it $4.5 trillion in Europe. I'm mentioning these numbers because these are really important markets. It's a really important asset class. It's difficult to talk about ESG and its impact on corporations without understanding the impact on ESG across all the capital structure, including debt financing. And as you well know, if you look at the literature, there's probably about 1,000 of papers written on ESG and equities. I will venture a guess that there's at least one order of magnitude fewer papers on bonds. So that lack of attention, in our view at least, is disproportionate to the importance of the space. Not to say that this is the first ever paper on bonds and ESG, it's not. So Laura Starks, who has some papers on bonds. We just saw Luke talk about sovereign bonds at least a little bit in this presentation. So I don't mean to say that we're the first, but I would hope to claim at least some incremental contributions on top of what people before us said. Also, in terms of data, we explicitly look at third-party data. Third-party meaning ESG data from vendors such as MSCI and Trucost. We chose those with an eye on what is actually used by real-world investors. And if you look at investor surveys, MSCI typically tops the list, and this is the point that Luke also made a few minutes ago. Trucost is also one of a leading providers of carbon emissions type data, for example. The secondary reason is that we happen to have point-in-time data from these vendors, at least for half a sample, starting in 2016. So we can actually control for what investors actually saw back in 2016, 17, 18, and so on. Okay. What do we do with the data? Well, two broad exercises. First of all, we look at the credit spreads as a measure of the ex-ante impact that ESG may have. So do investors price in ESG? And if they do, we should see this in terms of the narrowness or wideness of the spread. The reasonable hypothesis here would be that ESG would be a positive factor for investors, meaning that they would drive up the price of bonds issued by issuers with strong ESG characteristics. If that's the case, then we would predict to see a negative correlation between ESG characteristics and the width of a spread. So that's at least a clear null to be tested here. We also look ex post at the realized returns, and I'll it's a busy formula in the middle of the page. I'll explain this in a couple of slides. We look at returns, we look at volatility of returns. I will say that here the null hypothesis might not be quite as obvious, depending, even in this session, depending on which paper you want to take to base your prior on. You might expect positive or negative returns. Association with returns, I will say that we find basically zero throughout. So hopefully we don't make anybody too upset at the end of the day. Methodology, panel regressions, but if you read the paper, we try to be as careful as we could. We looked at the variety of other methodologies, Fama Macbeth, we looked at the variety of different controls and so on. Okay, so with that, what do we find? Let me start with the ex-ante measure, or the spread, and I'll show you results split between North America, well, US issuers and European issuers. I will also split them between investment grade and high yield bonds. By and large, they're similar, but there's a couple of interesting nuances that I wanted to point out this way. First of all, if you simply regress the spread of a given bond on measures of ESG, with usual controls for industry, country, whatever else, you tend to find this negative relationship that I was talking about is actually quite significant. So I'm showing you this for the US, I'll show you Europeans in a moment. That's nice, and this actually has been established in a couple of earlier papers. The message that we arrive at the end of the day, however, is that this basic result is not particularly robust. So very importantly, we also want to control for determinants of credit spreads that we already know from prior literature. For example, we know that probability of default is one of the key determinants of how narrow or wide a given issuer spread is. Now, if you look at the US investment grade and you put in our best measure of probability of default, that ESG coefficient still remains negative and significant. So maybe that's kind of good news. It does drop in terms of a magnitude. I'll come back to this in a moment. Interestingly, it's driven by this environmental part of ESG. This is the part that Luke was actually focusing on a second ago. But if you look at the US high yield, for example, then at least broad measures of ESG are no longer relevant, significant, but with a t-stat of -0.1, it's indistinguishable from zero or positive numbers. Interestingly, again, we do see this E element that seems to be important. If you flip to European issuers, if you flip the page to the European issuers, again, in a univariate with some industry controls and such, you still recover this finding that ESG is negatively correlated. But here, as soon as you actually put in any estimates of probability of default, any semblance of correlation with ESG disappears. Now, the fact that we find those negative coefficients, at least some of the time, still gave us pause. So we said, well, if we see low t-stats, it doesn't mean automatically that there is no effect there. It's just that it's difficult to estimate. So we tried to take the point estimates at the face value and just look at the economic significance of these. So what we did is we ran this thought experiment. What would happen to the credit spread of an issuer who moves from being really poor on ESG, and we thought about the 25th percentile of cross-sectional ESG scores, all the way to being pretty good. We look at the 75th percentile of ESG scores. The chart that you see in front of you measures the proportional change in the spread. So let me focus on the right-hand side of the chart, which shows you after controlling for probability of default. Well, US investment grade, we actually do find what I would call a sizable effect. If you do have that issuer moving from the first to the third quartile of ESG, the spread narrows by over 10%. So that's pretty, and if you remember, that's statistically significant. But pretty much anywhere else that we looked, so US high yield or European IG or high yield, we find not only insignificant results, but also in terms of the economic significance, the changes in the spread given by the point estimates are of the order of 4% or sub 4%, I would say. And Anna's point early on, is well taken. This could actually be some noise that we have in those estimates, not allowing us to recover the full magnitude of the effect. But at least, in those simple one provider only regressions, we actually found what we would call somewhat of an underwhelming effect on the credit spread. We found even less actually when it comes to returns. So first of all, what I think is a little bit of a methodological improvement. We don't look at returns and bond returns directly. We actually look at the cross-sectional credit excess returns, where we correct for the movements in the overall term structure. So we know that one of the primary determinants of returns are going to be movements in the term structure. And if we were able somehow to map corporate, so issuer level ESG scores to the movements in the overall term structure, but that probably wouldn't happen. And if it did, it would probably be just noise in the data. So first of all, we take out the movements in the overall term structure. Second, maybe less importantly, we also try to correct for the fact that issuers will have different volatility. So we normalize everything by DTS, which stands for duration times spread, which is essentially a measure of riskiness of risk in credit. Now, again, we would regress everything on ESG, on different measures of ESG. We would also, as before, try to put in a control for your typical kind of determinants of returns that we know from prior papers, think momentum, carry, and so on. It turns out that this part is actually less important for realized returns, because even in univariate regressions, we basically find zeros. So no relationship between ESG scores today and forward-looking subsequent returns that we see on these underlying bonds. We find nice confirmation that momentum, carry, value, quality still work, in a sense that those ex-ante measures of expected returns on bonds still come in significant in these regressions, but ESG is actually not there, even in univariate regressions for US, but again, same picture for European issuers. So we don't find any evidence that ESG will be incrementally helpful in understanding returns going forward. In our last measure of ex-post outcomes, we look at volatility, and here we actually do find something. And again, given time, let me focus on the right-hand side of this busy page. So what we do here is we try to predict the volatility of bond returns over the subsequent 12 months. So the experiment is that you start with your best measurements of ESG and whatever other drivers of volatility, and try to see whether ESG is incrementally helpful in understanding volatility that a given bond return will have over the subsequent 12 months. And the answer is that yes, it's not a massive effect, but statistically, certainly we found some evidence from most of the places we looked at, certainly in the US, for example, that there is this negative correlation between ESG scores today and subsequent volatility. Again, perhaps intuitive, those issuers that have stronger ESG characteristics have bonds that end up realizing less volatility than otherwise similar bonds issued by poor ESG issuers. I will say that that there's some nuance here. I won't go into every last detail. It's in the paper if you're interested. This experiment only works if you buy and hold for a year. If you actually allow for a little bit more dynamism, if you're able to revise your going forward, measures of volatility throughout, the next 12 months, for example, stopping at the end of each month, well, the importance of ESG is meaningfully declining. So this is more of maybe more of an important insight for those investors who have a bit of a longer horizon. And I think in a Q&A, Andrew was asking a question about the horizon. So I will say that if you face a very long horizon, but at the very least, we found some evidence that ESG is actually helpful in explaining volatility over those long horizons. So that's again for European issuers, we find similar patterns. At least for investment grade, for high yield, well, things get at least less significant, maybe not there, but at least for investment grade, we still recover similar patterns in the data. My last couple of slides are really about this second part of the paper, so portfolio implications. So if you think back to Ruixun's paper, well, by now we've established, at least to our comfort, that there is very little correlation between ESG measures and returns. So in terms of the impact of impact investing, impact of ESG investing, I don't expect much. It becomes effectively a constraint, at least in this setting, using the data that we have. So initial question is, how would it actually affect portfolio and the measures of attractiveness of the portfolio, somewhat similar to the analysis that Christoph did in the second paper in this session as well. So what we do, I won't read this page, it's a busy page, but what we do is effectively try to build hypothetical portfolios, back tests, if you will. And we try to map what we believe are important considerations that at least institutions would have in the space. So to try to build a portfolio that would be a plausible portfolio for an institution. And then our measures really are around this responsible investing. What happens when, compared to the base case of not doing anything with ESG, basically, you start adding more and more components. For example, you have those technical exclusions. Again, we saw those in Christoph's paper, when you exclude, X% of issuers with very bad ESG scores, a tilt when you kind of a positive screen, if you will, when you force the portfolio to hold more of the issuers with strong scores and so on. And I'll try to summarize everything in just one chart. Again, there's more detail in the paper if you're interested. So very importantly, and I think this is a point that is very underappreciated, we look at ex-ante measures of attractiveness. This is exactly what Luke was saying at the end of his paper. We're in perfect agreement. Looking at realized returns is just asking for trouble. So the reason for that is that a constraint could actually go in your favor. You can get lucky. I mean, if you restrict tobacco from your portfolio and tobacco does very poorly, then your portfolio looks like it's realizing higher return, even though it might be just noise. So what we do is we start with ex-ante measures of expected returns, again, based on those ideas of value, carry, etc. And we compare our estimate of forward-looking return of a portfolio without any ESG with what happens with portfolios that, for example, in the top left corner, use these technical exclusions. So exclude, 5% of stock of bonds with poor ESG, 10% of such bonds, 20% of such bonds, and so on. And you can read off what fraction of the ex-ante alpha you're actually leaving on the table, basically. Similarly, we look at the sustainability tilts. The picture that looks maybe a little bit more aggressive is this one in the bottom left corner when we look at carbon and carbon intensity reduction. It looks more aggressive because we actually went from building a portfolio with whatever amount of emission that holds all the way to a portfolio that tries to lower emissions by essentially 90% versus a credit benchmark, which actually is a very aggressive constraint. The bottom line for us, at least, and this again echoes some of the findings from other papers, is that maybe surprisingly, forcing some ESG objectives on your portfolio. And I'm saying forcing again in this purely mathematical sense of a constraint. These are sort of real investors' preferences that we're talking about. But if you actually impose those preferences on a portfolio, at least within some space of those preferences, we see very little impact on ex-ante measures of portfolio attractiveness. So for example, you can run a portfolio with screening 10% of issuers out there, forcing a tilt towards more higher ESG score issuers, targeting a reduction in the carbon footprint of the portfolio, and still only lose on the ex-ante basis a few percentage points of your ex-ante, again, expected returns or risk-adjusted returns. My last slide, and I'll conclude here, is again coming back to the goal here. The goal was to try to understand, is ESG useful in explaining patterns in prices? And I think the answer is a qualified yes. We found some evidence for credit spreads. That's probably the strongest piece of the evidence. Again, if you're willing to hold the portfolio for long enough, then ESG will be an incrementally useful instrument to understand the risks of your portfolio. For example, we found basically no evidence for credit excess returns. Again, using those third-party data sources that I mentioned before. We did, I didn't go very deep in there, but we did, I think, find interesting insights for investors who want to incorporate sustainability or ESG into their portfolios. I will say that we always would lead that beware of claims of win-win. I don't think you can have a portfolio with strictly better risk-return trade-offs, if we didn't find any evidence for ESG driving the returns, at least. And yet we would still conclude that maybe you can have your cake and to some extent eat it, unless you're extremely aggressive on the type of ESG objectives that you pursue in a portfolio. I think I'm out of time at this point, so I'll pause here. Thank you.
Terrific. Thank you very much. We did have, so that's the conclusion of the presentations. We do have some time for additional questions. There's nothing currently in the Q&A, but the one question that did come up a couple of times on Luke's paper, the issue of does investor horizon matter? And then if not, why not? And particularly given the potential for future regulation.
Thanks, Stu. Yeah, so I see that my co-author answered in the chat, which not everyone can see that. So the argument here is that markets are efficient. If we expect certain policies to occur in the future, well, those expectations are already impounded into prices today. So those expectations don't have any effect on expected future returns. That would be my answer there.
Okay.
The other side of that answer. So the other side of the answer is the risk part of it, right? So Luke's right about the expectations should be baked into the price, but there could be uncertainty about regulation that gives rise to risk and potential risk premia. So, for example, future carbon taxes. If future carbon taxes are higher than folks expect, presumably that's going to be, worse for brown firms and better for relatively better for green firms. The question is, what's the risk premium on that risk, right? So if carbon taxes end up being unexpectedly higher than the market expects, what's the representative investor's view of that? Is it a bad thing or a good thing? And that would determine the risk premium. For example, if unexpectedly high carbon taxes mean that the climate got unexpectedly worse, we got worse climate news than we expected, and that was what precipitated the unexpectedly higher carbon taxes, then I think to many investors that might be seen as bad news. So in that sense, brown stocks would command a positive risk premium relative to green. But signing that risk premium could be tricky, right? I mean, you have to say, well, if carbon taxes are unexpectedly higher, is that a good thing or bad thing for the representative investor, and what would precipitate that? That's a little trickier. So that could very well be part of what enters the risk premium.
If I can add to that, another aspect to Andrew's question is there's a possibility which is outside our model that some investors simply don't understand, that there are these stranded assets, and it's only in the long run that they will come to understand. And if that's the case, there is mispricing, and yes, then green assets can continue outperforming brown in that scenario.
Luba, you had a question for Anna. Did you want to go ahead and put that to her?
Sure. Yeah. Anna had a very nice paper, very clever approach with the instrumental variable. And I was just wondering whether if I were to do something much simpler and much less clever, and simply average the ESG scores across the 8 providers that I believe Anna uses, I think under her assumption that all ESG scores are equal to the true ESGness plus IID noise. Under that assumption, I think that average should be pretty informative about the true ESGness. So I'm wondering, why not use that?
Yeah, so that's absolutely right. But that assumption, as we see with our violation of the Hansen-J test, is not a good assumption, unfortunately, for ESG raters. So the error that we suspect is there the problem that we suspect is there the most is the fact that errors in what you said, truth plus noise, the noises are correlated. And once they're correlated, especially positively correlated, this is when this average starts misbehaving. And in the version of the paper that we have posted, we do simulations. And when you have this correlation of errors, this just OLS based on the ESG, average ESG rating, simple average, does not do that well. So in that sense, some idea of averaging is good, but it has to be a more intelligent averaging than just putting an equal weight. So somehow this weight should incorporate the noise in the rating, and it should also put zero weight on instruments that we should just toss out. So in some sense, this is what our first stage does. It constructs this intelligent average.
Thanks, Anna. I suspected the answer would be, something more intelligent than what I could come up with. So thanks for clarifying.
No, this is great question. And, you actually asked it to me before, and we have written the whole section with a simulation addressing this question. So it's a very good one. Thank you.
One question I have is, and this sort of can be asked by anyone. Perhaps I'll put it to Christoph first, and then we could see if others have thoughts. You know, the definition of the measure of ESG varies dramatically across the data providers, across the papers. Even in the green paper, the definition of MSCI's E is based on 13 different measures which capture aspects of climate change, but also other measures of environmental safety. Do you think there is the potential for more sharper testing in the context of more specific measures of the components that go into those ESG indices?
Yeah, for sure. I think in general, you face a trade-off in this space between how comprehensive is it what you're capturing and how precise can you measure that. I think that's something that other papers have argued about as well. If you are trying to be very precise and you're just interested in carbon risk, that is something you can measure to some degree with a high precision. The moment you're trying to target something that is broader and bigger, which many investors care about, just general goodness, right? How good is this firm? How bad is this firm? And you start aggregating characteristics across a broad range of different things, you're sort of mechanically almost going to mix things together that maybe shouldn't be compared necessarily, right? So this is almost, I mean, I think this is almost built into the idea of having a comprehensive sort of ESG measure. In terms of our findings and our results, what gives us a lot of confidence is that the results stay very similar if we focus on individual subcomponents, if we focus on individual items that are part of the measures that are maybe estimated more precisely, and the results stay very similar across those. But I think in general, yes, you face that type of trade-off.
Anna, did you have any thoughts on that in terms of, I know you mentioned in the paper you used to discuss a little bit focusing on other components as a possibility for future work, or the materiality considerations also?
Right. So our message is that the more granular you go, the better, because when you have aggregation, you inevitably have fewer instruments than sources of noise. So once you go more granular for ESG to E, in simulations, this clearly improves the closeness of our estimator to the truth. And as you go within E to carbon, then of course we can estimate it absolutely perfectly. That would be my answer.
Okay. So Luke, to follow up on that from the carbon perspective, so you're using the MSCI. I think there's 13 different elements. Carbon's going to be one component of that. What are your thoughts on that? Would you think about, would this change dramatically if you were to focus specifically on carbon estimates?
Yeah, it's a good point. Climate change is one component of the MSCI variables that we use. We think there's a risk of, we think it's a totally reasonable question, and it's one we might look into to kind of drill down to more granular MSCI variables. But it's not obviously the right thing to do. I think for almost every single MSCI subvariable you see, you can make the argument that that variable is related to climate change. One example would be the MSCI variable called, it's called clean energy opportunities. That is not part of climate change in MSCI, but you can make the argument that clean energy is highly relevant to climate change. So I think it's reasonable to look at. We might look at it, but it's not obviously the right thing to do.
Okay. There was another question that came up earlier in the Q&A, and it pertains to the fact that a lot of the data providers provide their measures on an annual basis. I think it was rep risk and true value provide them more frequently. So it would also, so in some sense, it's not surprising that the aspects of true value or rep risk would lead the other indices, which also focus on bad news in particular for downgrading ratings. What are your thoughts on sort of the periodicity of the available data and how that would impact the way you think about testing this empirically? I'll put it to maybe to Luke first, and then I'll put it back over to Christoph.
Yeah, I don't know. I know the MSCI data pretty well. They update their ratings at least once a year, often more than once a year. For example, if a company has a salient event, they will update their ratings shortly after that event. How much does this matter? It's not clear because these ESG scores are incredibly persistent over time.
Christoph,
Yeah.
I see you're going, Anna, let me go to you because you've used the true value and the rep risk.
Yeah, no, I mean, I was nodding my head so strongly because I completely agree with Luke's last point. From my experience with working with the data, the data providers or the ESG series are very persistent over time. So if this is true across years, I'm not sure how much additional information we would get out of having the same persistence at a monthly frequency. Although as an econometrician, if you ask me, do I want more data? Of course, I'm going to tell yes, I'm very much interested in that, right? There is Sustainalytics, I think, is also released at the monthly frequency, and it doesn't really help us find any sort of better or different results. So I'm not sure how much that would improve things. I guess you have also a trade-off between how well can you collect these types of measures at the ratings agency and how frequently do you have to release them, right? I think one thing that would really help us, I think, or generally researchers would be if it was a little bit more transparent at what point these data points are available to the markets and what visibility there is. I think those would be very interesting things to add in terms of the data on top of maybe just the frequency question.
But I think we have to admit it, that our identification is primarily cross-sectional. So we really don't have much of a time series. And that's the nature of ESG. It's a new thing. And well, later on, there will be more data, but for now, this is what we've got, but we have a huge cross section.
Luke, you had a question, and then Lukasz has a question.
Sure. This is a question for Anna and her co-authors. It's also relevant to her co-author's previous paper. Why is the null that these different ratings providers are all trying to measure the same thing? We know there are differentiated ESG clienteles out there. If you're one of these ratings provider, why isn't the better strategy to create a differentiated ratings product from your competitors? And I should throw Lukasz Pomorski under the bus. He was the one who gave me this idea originally.
All right, I can tell about our estimation, but let the co-authors on the previous paper reply to the marketing strategy. So for the estimation, yes, it is an issue that each ESG rating is a combination of indicator, but potentially some overlapping sets of these indicators, but not the exact ones. But again, if you see this issue from the viewpoint of instrumental variables, yeah, you have this problem with the fewer instruments and the sources of noise, but in the end, it still works. Yeah, people are saying that, you know, scores of one rater might not be relevant for another rater. You saw our first stage F stats. Remember, one was 7,000. So there is no issue of relevance there. So they are trying to measure something that is overlapping. And yes, completely dealing with this issue of them measuring different things would be going more and more and more granular. And this is when estimation, of course, improves as you get more instruments for the variable that you want to capture. And then let me turn it over to my co-authors to answer your second question.
Yeah, I think so. I think that would be reasonable, right? You would think one tries to go for the churches, and the other one for U.S. institutionals, and another one for individuals in Europe. But honestly, it's not the way I've perceived it. Looking at these rating agencies over the years, my impression is more that each and every one of them has started, you know, with this ambition. Let's measure how good companies are, and they've built their own methodologies. That, you know, there's millions of ways how you could do that, and once you've established some sort of method, it's very interesting to keep it going, right? Because then you can argue, well, we have consistent data sets, and so my impression is they don't differentiate themselves by what they're trying to measure. They try to differentiate themselves by how they're measuring it, and they argue why their method is superior in one or another way. But they all tend to try to sell to everyone who wants to know about ESG. That's the way I perceive it. and that's, I think, supports our null hypothesis there. That's a good question. Thank you.
Lukasz, you had a question.
Well, more of a comment, and while I agree with a lot of what has been said, I do have somewhat different views on some points, so having been thrown under the bus, let me by Luke, thank you. Let me just comment on this. Julian, I know what you mean, and I agree partially, but I also would actually argue that in some cases you have very clearly differentiated products. When you ask True Value Labs what it is that they do, they will explain that they look at the media, they look at measures of headline risk. I guess rep risk is an even better example of this. You have providers that by definition only look at the whole processes, only look at company issued information, and you have others like MSCI who at least claim that I forget if it's 60 or 70% of the data they use comes from outside of the company. So whether do they still try to get at the same thing? Perhaps, but if they do this in a very differentiated manner, and I don't know in terms of the IO of how they operate, I don't know that you could actually support different outcomes with so many companies. There's also really interesting sort of time series dynamics of that. If you talk to those providers, they have been more different in the past. So for example, today the state of the art seems to be, not for all again, but for many, to look at the exposure to ESG type risks, but also what the underlying issue or the company is doing to manage those risks. This was not the case. If you go back to 2015 or 16, I think only MSCI, to my knowledge at least, was actually doing this already then. And nowadays, many other companies, Visuaris Analytics actually picked up on somewhat similar ideas. And maybe just to be a little bit controversial, I will also say that I'm actually of the opinion that those scores are surprisingly highly correlated. And I know that Julian, we work together on a number of other initiatives, so please take it with in good spirit, and Roberto and so on, Anna. My sense is that if you look at the randomly drawn two providers and you end up seeing that they're 50% correlated, that's surprisingly high, given, again, in my view at least, how differentiated our processes are. To me, this is exactly the point of the paper that Anna presented. There's some commonality there. We're going about this in very different ways, but at the end of the day, this is great. We have different observations of the same true ESG-ness. Maybe we can extract the latent variable this way. So I'm actually bullish on that. And the last thing I'll say is that, again, take it. This is meant to be just a small sort of comment, but I don't know that we are doing anybody a favor if we talk about the correlations between credit rating providers and compare them to correlations of ESG providers. Different space altogether. I mean, in my view, at least, a much better analogy would be to look at the correlation between earnings estimates. If you take sell-side analysts and look at the earnings estimates, would we expect that those correlations are 90%, for example? I wouldn't. They happen to be closer to the correlation between ESG providers than correlations between credit rating agencies.
We have an audience question from Laura Starks. Doesn't the difficulty of even defining ESG enter into this debate? Perhaps I will go to Anna first. So the question again, the question is, doesn't the difficulty of even defining ESG enter into this debate? So the fact that we're seeing vastly different definitions of ESG across both the investment community and the academic community.
Yeah, definitely. And actually, I've seen Laura herself respond to this question. Somebody asked her a question. Does it make sense to do it at the level of ESG? Shouldn't we be doing it at the level of ES and G? Because how we put them together into ESG is very subjective. And the answer Laura gave was as an unqualified yes. So we should really be looking at the pillars separately than at the combined.
Would anyone like to add more on that?
I'm happy to give it a shot. I think we need. I agree with Anna and Laura. We need to break it up into E, S, and G. I would break it up further into E1, E2, E3, S1, S2, at the minimum, like S Democrat, S Republican. Even for E, I mean, there's a big debate. Many of you are aware of the big debate on nuclear energy in Europe. You have Germany and friends arguing nuclear is brown, and you have France and friends arguing nuclear energy is green. And I think they'll come up with some sort of a compromise. But, you know, again, you should have E1 and E2, E1 for German investors and E2 for French investors. I don't see why we need to have just one E.
One interesting thing that I saw in a paper recently on the carbon emissions is that in some cases, the data providers will impute the level of carbon emissions based on either industry or firm level output. Do you have does anyone have any thoughts on how that might impact your measurements? Anyone want to take a shot at that?
I'm happy to. Okay. So so it depends on which dimension of carbon you look at. So if you look at the what is referred to as scope 1 and scope 2 emissions, so the emissions of the company itself, or emissions that are traced to the purchases of energy, of electricity, for example, steam, heating, by the company, these are surprisingly highly correlated, even if you zoom in on only those that are estimated, as in not reported by the portfolio company itself. And there's a really nice paper, and I apologize, I'm bad with names. I know it's from, I think, 3 people at the University of Hamburg. They did this nice experiment, very similar actually to what Anna presented, and looking at the correlations between different providers of carbon data specifically, and they found, I think, 70–80% correlations even for estimated data. If you look at scope 3, which is emissions that are traced to the supply chain, so emissions of your customers, emissions of your suppliers, that's basically 0. So at best, one of those providers is giving good numbers there. Probably nobody really knows what they really are.
Thank you. We're almost out of official time for the session. I'm not seeing any further questions in the Q&A. Does anyone of our authors have any final questions that they want to put to anybody else? Okay, well, in that case, I'd like to thank everybody for attending again. I think there's 5 just fascinating papers here. I look forward to seeing the future iterations, and thank everybody for joining us today, and thanks to the audience participants also. It's been a pleasure. Thank you.